Welcome to the Dividend Talk podcast, episode number 19, Earning Results from Dividend Day. So today, my number one fan, my wife, is going to do the introduction. Take it away, darling.
Yo, this is me, EMF, coming to you with all your up-to-date dividend talk. That's it, your number one rated dividend podcast. See you on the inside.
Hey, what's going on? Day 2 after Dividend Day yesterday. How are we getting on?
I'm good. I had a day off today, so I'm happy that I could sleep a little bit after yesterday. But I must say, I really enjoyed it. It's just great to talk with like-minded people. I think we spoke for 3 hours yesterday, together with Dividend Wave and Phil, and it was really cool. And the excitement when the Intel earnings came in, it was like second to none. And then when we saw the share price, it was like, wow, cool. Wow, see 10%. I mean, it was really great to do that live. It was like we were in a soccer stadium or something like that. It was really cool yesterday.
Yeah, it was awesome to meet Dividend Wave. We've had Phil on the show. We spoke to him a couple of times, but I always enjoy just talking about stocks, getting on and meeting new people. And like you said, that Intel, when we're just going through that live, the total shock, it was brilliant. But we'll get to that later on in the show. But we were up till I don't know 1, 2 o'clock in the morning in your time, and it was it's great, and we're probably going to do it again, and love more people to join. It was good fun. But aside from that, has anything stuck out in the news this week? I see you have something in Dutch, so I can't even read it.
No, don't worry. I'll do my best to translate it. Now, what caught my attention this week, and I'm sharing this mainly for the people that are holding European bank stocks, is that the fact that one of those European institutions, I think from the ECB, they are considering to still keep to forbid banks paying out a dividend because of the second COVID-19 wave hitting Europe. So they're afraid that it will hit the balance sheets again. So they rather have them being safe than sorry. So there seems to be some rumors that they will continue asking banks not to pay out any dividends. And I think for a dividend investor being invested in banks, it just shows like how much political influence there is, because you're kind of, as a bank, you could bring an economy down. So it's so regulated that dividends are just not safe in this industry. Hence why I'm staying away from it. But if there are listeners of us that have banks in their portfolio, then this doesn't sound good from a dividend income point of view.
I know you must be disappointed with that news, because I know how much you love banks. So this must come as a huge shock.
Shall I say it again? The bankers are wankers? No. I know that we have few folks on in the Twitter community that actually work in the financial industry, and I don't want to insult them. My anger is still a bit there, because I think banks collectively haven't paid the bill yet for the 2008 crisis, and I've seen in a close proximity what it has done to people and to people's wealth, and I still feel like still have my emotions there, let's say.
Cool. So I think we should just move straight on to the main topic. I think we have 9 companies here to look at. So
yes.
we'll go through 3 or 4 of them in a little bit of detail, and then we'll have some sort of lightning round, and we'll discuss a couple of them. But I suppose that the first one that I'd like to speak about is AT&T, which will surprise me. But do you want to talk us through a little bit of what you found on that?
Well, let's start just with my overall feeling, right? Because we don't have so much time if we want to go in depth on all the AT&Ts. But what I really liked about the fact of AT&T was that it sounded like they found a little bit their mojo back in the last quarter. So I think they did pretty smart with getting the HBO Max subscribers up. That was a really good sign. Free cash flow was again pretty well. So the dividend payout ratio is less than 50%. So it means they can have ample room to keep paying the dividends. And because of the debt, this is all the time this big question mark about AT&T. They also reduced debt. It was around 3 billion on a debt load of 150. So hey, it's again 2%, right? If they do 2% every quarter, you hit 8% per year. Then if they continue like that and are able to work a little bit on upping their free cash flow, then finally we have a board of directors there that's getting it. And starting to, I said, resolve and clean up some of the mistakes from the past. So that's really what I liked. And those HBO subscribers for me is a little bit what you see also with a company like Disney and such, that they're just hard growing. And then if you hear the Netflix numbers at the moment, Netflix is just struggling at the moment to properly grow. So I know that HBO comes from a lower base, but this is the power what AT&T has with Time Warner. They have content as well, and then with HBO, and then bundling it with new subscriptions or something like that. That's really where the power is, in my opinion. And this is how they did in the past as well with the old TV, right? Subscriptions. So why not doing it with streaming services?
I mean, the only negative that I could find in that earnings report was DirecTV. I mean, we know that was a bit of a disaster, and it's kind of pulling him down a little bit. But it was a solid report from him, and it's probably going to stop that slide in share price, and they may hover back up over $30. But I mean, at the moment, I have a full position in him, but if I didn't, I would certainly look to maybe add a little bit under 30 at the current prices, because they've already stated that the dividend is safe, and they're prioritizing that. They've plenty of cash flow. So no, it looks good, and looking forward to see how they grow over the next quarter as well.
Yeah, I think at least the fear is a bit taken out of it with this quarterly earnings report, because I think there was a lot of fear and build up over the last few months, hence why the price went down, and specifically when the news was coming out. When was it? At the end of August, or even maybe in October. I think in October was the news that they were considering to sell DirecTV for 20 billion, which would be like 2/3 of loss in value. And if you then get such an impairment upcoming, that could be really, really painful, right? And this is still above the market, of course, because if they indeed sell it for such an amount of money, then they can pay off some debt. But that's quite a impairment on a business that they just recently, a few years ago, bought. I mean,
Yeah, very good. So both pleasantly surprised by their earnings, and by contrast, then we have Intel's earnings, which we alluded to in the intro. And I mean, that was quite interesting. And I'm just going to start with a summary that we read from the CEO, Bob Swan, and it was: our teams delivered solid third quarter results that exceeded our expectations. So, I mean, we saw this quote after we went through the report, and
my God,
we couldn't quite believe it. But I took some time this morning and this evening to actually digest the numbers. When we were doing it live, we had a bit of fun. But Intel actually beat revenue expectations by a small margin, but they still beat them, and earnings per share kind of met earnings. They had strong free cash flow, which gives them, I think it was a 17% payout ratio, so 8.2 billion and 1.4 in dividends. And they're buying back lots of shares when the stock is cheap. The PC business grew as well by 1%. So on the face of it, it seemed good. But then you have the data group. And again, we had some positive signs. You see that the cloud business grew. But then you look at, after that, then you have the enterprise and government business shrank by 47%. And this shrunk after they said, well, they claimed that it grew 30% over the last 2 quarters. So they're blaming COVID here, which is understandable. It's an easy get out clause. But for me, there's something more at play here. It can't be just COVID, and investors are not just going to pull out, because we would expect it to drop, but not by 47%. There has to be something a little bit more, maybe some macroeconomics, or there's something else.
This is corporate bullshit. This is really corporate bullshit. And I mean, expectations, they set expectations and they were low. Yeah, but if you then, I mean, if you then can hardly beat them from such a low basis, and then your main catalyst is really, really performing poorly. I mean, you call out clouds, but that's really when you start looking for a needle in a haystack to find something positive in this report.
Yeah,
For me, Intel, the concerns for me that I had are hereby proven. I don't see them anymore as being competitive as such. And yes, the good thing is that the dividend payout ratio is low. But and I also like that they are buying back shares while the price is low. I'm just wondering whether at this moment in time they shouldn't use that cash maybe for doubling down on innovation at the moment. So if they would just like only do half of the buybacks, so I don't I actually like it buying back at a low price, but they should really double down on innovation at the moment because that's where the pain is.
and one thing that bothered me a small bit was they have bought back heavily. They've bought back I think 12. I can't remember the figure, but they bought back a considerable amount of shares, but their earnings didn't grow. Now, you'd imagine if they're buying back that amount, their earnings should at least grow a little bit, if less shares. So there's lots of concern, but they're a strong cash company. They're a bit of a cash cow. Plenty
Yeah.
around. So as a dividend investment, I'm not too concerned. And my original thesis for my blog post hasn't changed a whole lot, but there is definitely concerns on them. And look, I believe that the drop, the 10% drop, was definitely justified.
Look, if at these prices, you could easily say like, you can initiate a small position. Yeah,
Hmm.
why not? If you believe that this company is still there 20 years from now, I personally think that they will go enter a period like IBM is in. Yeah,
Yeah,
that the other competitors are ahead of the game. So the only thing that of what IBM has been doing with declining revenues as such, they have been starting to financially engineer, buying back shares. Intel has the cash flow to all do this.
yeah,
Um, I would rather see that IBM would have had bought Red Hat 8 years or 10 years ago instead of wasting all that money on buybacks at higher prices. So, but hey, I said sometimes it's worth a gamble on this and just wait until management turns the ship again into the right direction.
cool. So we'll move on to some European stocks. You might as well give it a European flavor. So if you want to talk through Unilever, I know you've had a little look at them during the week.
Yeah. So what is probably good to know, right? What I like about, for instance, the AT&T report, they give like from the 10 quarters a really nice overview. What many European stocks do, they don't give earnings results as such. They give trading state updates. So they rather talk about the sales. This makes it a bit harder to figure out what their earnings will be or what their free cash flow is. However, I've learned a little bit with Unilever how to read them. And in this case, they have an underlying sales growth of 4.4%, which is for me really strong for a company like Unilever. They were not doing so well when it came to revenue growth. And for me, this was a really strong quarter from that point of view. Um, what I actually would like to say is that 4.4% is their underlying performance because they have excluded from that a 7.7% currency impact. So if you include the currency impact, actually there's a bit of a sales decline. But we all know, we saw it in our portfolios what the US dollar has done. So I find it kind of fair to call it out here. I don't really, in this case, I give them an out of jail card. Usually I'm not so easy on this. But what impressed me again is that their online channels really are growing with 76% again. Of course, it's not a high basis as their normal business, but it just shows that they are able to transition into the online space this year as well. And what I want people to take away from Unilever in general is that their catalyst is really the developing and the emerging markets, and specifically Asia. They grew 5.3% in the emerging markets, really a lot in China. And also when we look at Asia itself, there was again a big growth, but also Americas grew a lot this year, or this quarter. So the numbers look really good, and knowing that the emerging markets are their biggest net contributor to sales, and they are growing the best, it just looks really good for this company. So for me, strong numbers. The share price went a little bit down. Actually, I would say that probably creates quicker buyer opportunities for us. I'm hunting a little bit always around between, ideally 45, but I wouldn't mind to take a little bit of few shares again below 50, just to nibble in again. So all in all, pretty decent earnings report.
Yeah. And then we had Danone, then a trading statement as well, which I know again another one of your all time favorites. But I mean they had sales down by, was it 2.5%, mainly due to they had currency impact and the performance, the water, restaurants and clothes. They've lots of, I suppose COVID has impacted them a good bit, but they have 1.8 billion in free cash flow. And they are predicting low kind of profitable growth rate on that. So you know a little bit more about the performance from recent years, but just looking at it from here, the water sales I think was down 19% over from last year, which is massive. And then they have specialized nutrition down 11% and EDP down 4%. So they have been heavily impacted by COVID. But you're bullish on them at this moment, eh?
Yeah, I'm really bullish on them. Not so much, how is it? I'm bullish on them because of the valuation of the shares. Yes, so there's a company with some problems. Their problems are actually not in these sales, because I would like to really call out that when we talk about waters here, those are not the waters of Evian that you see in the shop, in the supermarket. Those are up generally, at least according to the half-year statement, because there we got all the insight and the data. It's just the issue here are restaurants. And many people buy a bottle of water in a restaurant, sparkling water, distilled water, and that's where they have high margins. That's really down in sales compared to last year. I mean, you've seen yourself summers how the restaurants, how they were this year. That's an issue. Specialized nutrition is really about the baby milk powder and such. It's much more harder to at this moment to ship stuff to China and such because of the coronavirus. So also that is impacted. Also high margin. And if you look at specialized nutrition, it's actually the most profitable business unit that they have. They have margins around 25%. So having said that, those are issues. But those are issues related to Corona, one-on-one. So I'm convinced they will pass. And cash flow is down from 2.5 billion to 1.8 billion, which is a lot. Dividend is still covered. I expect if they would do a small hike next year, the dividend payout will come at 80%. What the issue has been here is management. And management has not been hitting the targets. And I had a really nice conversation with someone on Twitter the other day who also gave some really nice insights, and it really helped. So I really want to thank the Twitter community here. But this is what it is. They have been all the time over-promising a little bit. But this time, what I really liked in the report is that they took action. The CEO took action, is having now two, I don't know if they're, how do you call them, COOs or operational officers. They're really going to become responsible for a line of business, get more empowerment. And I think this is a really good thing with their own P&L. And in Q1, they should get back on track for growth again. If they feel that, it will be probably a company that will be struggling for another 3 years. But then again, for around 50 euros, you've got a really good margin of safety of just more than 20%. So for me, it's really a value play, knowing that it has a really good dividend growth history. So it's also a Noble 30 member. And that's how I look at this. So I'm actually quite optimistic about this report. The share price went down, but I look at it a little bit with another lens to these earnings.
Yeah, very good. So they were our main four companies, I suppose. So we might do a lightning round for the next, was it five or six companies? We'll start with the first one, which is called Assa Abloy. So for those that don't know, it's a Swedish company who offers services ranging from locks, doors, gates, and entrance automation. They also include like biometrics and mobile tags and verification systems. And they are, I mean, I could imagine, but they are really struggling due to COVID. I know you put up a tweet about it, but the quarter 3 earnings looked strong. So the year to date they were down 23%, but quarter 3 year earnings was only down 6% year on year, and the dividend looked pretty safe. You might have more specific numbers on that.
I can just say that it's a lightning round, but I like always the wording here that the dividend is safe. So they're making locks and everything. So, I mean, it better be safe in this case, right? Now, but this is to your point. It is nice to see that it so quickly recovers in the summer when the economy opened up a little bit again. So again, impacted by COVID. I would just like to see the share price being much more down. I don't find it attractive to buy at this moment.
Okay. So
then we have another company that's Novozymes, and also for Dividend, Dane, thank you for providing some more information also on this company to us. So this is again a biotech company, which is from Copenhagen, Denmark, and it's really focused on research and development and production of industrial enzymes, microorganisms, and biopharmaceutical ingredients. And for the people that don't know really the company, and I'm quite, I don't know the company so well, but from what I read all the time and what I glance over, I really like what I'm seeing from this company. They're struggling also a little bit. Growth is in general flat for the first 9 months of 2020, but it's flat. Yeah, it's not too much down, and their portfolio is pretty well balanced, which means that some are up then and some are down. I said, and what I just wanted to say is like they are really rich valued, but with 35 PA. But this is where Dividend Dane came in. He gave a really nice story about they're really struggling and such. However, the long-term growth is really there, and he also mentioned that this is one of those companies that's really highly regarded in the market for their quality of products. So I need to do more research on Novozymes. The share price responded. It went a bit down several percent. Personally, I find it a really interesting company for further research, but I will only start doing that when the price comes down, because on such a PE, I don't even want to spend too much time on researching it.
Great. Okay, and then the next one we have was Coca-Cola. So if anyone follows Investment Talk, I know we had him on the show. He wrote a thread on Twitter about it, which is a good thread. But then he also has a newsletter, and he has a 24-page report on this, and it's worth subscribing and reading these reports. I don't know how he does it. I said to him, he's an absolute machine how he does it. But touching on Coca-Cola, I mean, it's one of those companies where COVID was really going to impact their sales, and I'm not really surprised to see the declines. I mean, earnings per share down 33%, and their revenues down 9%. A little bit worried about them at the moment. I think they're in for a long, hard year. We're not coming out of. We're back down in lockdown. Restaurants not opening, they're closing here, and I can just see them struggling for the next 6 to 9 months. So I'm concerned, really concerned about them. I have a small position in them, so that's fine. But it didn't look too good on the numbers.
Yeah, and this is the issue, right? Restaurants. Either you buy an Evian water in the restaurant or you buy a Coke. So, yeah, I mean, that's the whole narrative, I think, around Coca-Cola for now. Countries need to reopen. We should all be forgetting about social distancing again, sitting in Paris really close to each other, butt to butt in a restaurant, and order a Coke. That's when this company will thrive again.
Yeah. And then we have good old IBM. So we've talked about them earlier. another really disappointing result from them. I was really looking forward to seeing how Red Hat did, and look, their revenue was up 17%, which is good. But I mean, IBM dropped another 10% as well, I think.
Yeah,
That
it was
they're,
also hit hard.
they're really struggling to adapt. So I think we mentioned it last week. This split, this spin off that they're going to have might have a positive effect. So I'm not going to judge them too hard at the moment. I want to see how they react to this spin off and where they go from there. But at the moment, I'm sitting on the sidelines. My money's on Red Hat, and just waiting to see how they progress.
Yeah, I'm a little bit less optimistic because I dialed into the earnings call on Monday night, and I even put it on Twitter. There was a really good analyst question, and I will read it here. He said, "Your dividend is 6 billion a year. It's basically been 100% a year free cash flow year to date in the last. You haven't paid down any debt. You haven't done any deals without taking on incremental debt this year. So if you are really managing the business for the long term and growth is a priority, are you considering lowering or suspending the dividend, or is the dividend safe?" And then this Jim Kavanaugh comes in again, blah 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 blah. We are super, and we're almighty. We are IBM. Who the fuck are you asking me this question, you stupid analyst? That was kind of a little bit what you get away from it. And then I'm waiting. Okay, now it comes because new CEO starts talking, and this is what I'm really looking at. Does this CEO understand what he's doing? And then at least he had a question, at least that was trying to answer it. So he really started telling, "Oh, nice, we're going to use the cash from the balance sheet to pay down debt." I feel like, why would you use the cash to pay down the debt? Probably they make the cash is more important. How is it more costly than what they can get as a return on the cash? They say, and we commit to growing dividend, and we will invest more. And I think, like, has this guy been listening? Yeah, there is no money left after the dividend, or hardly any left. So how are they going to do that? So I'm thinking, like, does the CEO actually know what he is saying, or is he reading from a slide that they once wrote 2 years ago about their capital allocation strategy? Because I have a feeling that he lost reality. So these guys are living in a bubble. The CEO is totally not, for me, convincing with such kind of answers that he is on top of things. He could have said, as example, "Yeah, we commit to growing dividend. That's why we are not doing buybacks. That's why we're not paying down the debt for now. We live in a low interest environment." Then at least you get like a common sense answer. But this answer made totally no sense because the math just doesn't work with what this guy was saying. So for me, this is a red flag.
Yeah, it doesn't give you much hope for the CEO if he doesn't really know what he's talking about, or where his business is at. Then I mean, it doesn't look good. But as I said, I'm waiting for the spin-off. I'm really hoping that this may change how they're doing, and
Yeah.
look, we'll see. But again, another disappointing result from them, and they were punished by price, and rightly so. So we might finish then on one last European stock, one of your favorites, Nestle.
Yeah. For me, there was nothing worth mentioning there. So I really would like to keep it like that. This Nestle is for me a company. I did a real, like, few months ago, deep analysis on it for myself, and this company is just financial engineering. I know there are some people on Twitter quite happy with Nestle, with what they're doing, but I don't see value in there. I find it quite pricey, and if I then compare it to Unilever or Danone, then it's a clear case that Nestle is not even worth considering for me. And with the sales numbers as well, there was really nothing new there, nothing specific there. So for me, yeah,
Okay.
not even worth mentioning.
I kind of guessed you'd say that. So move on to the next section, which is the listener questions. And we'll start with one from Centrino. And his question was, what's your goal with dividend stocks? And look, he's expanded on that. Are you going to reinvest them? But I maybe just ask you for your answer.
Yeah, so my goal is indeed to reinvest those dividends continuously. So every month I can invest, I've got 23% to 25% of my expenses covered, but I'm now reinvesting them every month. So I can, let's say, I can invest 23% more on top of my monthly contribution at the moment. So because I have a 50% expense ratio versus what I can invest. So I'm doing that, and that's really a nice feeling that you can put another 20% on top of it. So I'm reinvesting that. The snowball starts rolling, and yeah, when I'm at retirement age, I will not reinvest them anymore because I will start living from them. However, I look at it at retirement age that I would like to have my expenses plus 10 or 20% to have a margin of safety for when I have some one-off expenses that I can cover them and not directly need to go to my emergency fund. So that's my goal.
Cool. Okay.
How about you, by the way?
It's similar for me. I'm reinvesting them until I retire. I hope to retire a little bit early. I've spoke to you about this. I've kind of changed my strategy a little bit. I'm trying to pay down my mortgage as well, aggressively over the last while. But I'm still keeping the same amount that I have every month for the last 3 years. I'm paying that in every month. So I'll just keep plodding along with that. And when I retire, like you, I won't be reinvesting then. I'll be just trying to live and enjoy myself. So I suppose that's the goal for most of us. That's why we're investing for that income, isn't it? To get to retirement and to be able to live off it. So that's my goal anyway.
Then Phil had also a question. Thanks, Phil. Hypothetically, business doesn't go well. How do you want your company to react? Keeping margins up with the risk of reduced sales revenue, or reducing margins to keep sales revenue stable? This one's for you.
Oh, it's a really, really good question. And I don't know that they're both. It would depend, but if you were to push me, I would probably say reduce margins to keep sales revenue stable. I mean, I don't know. I struggle with that one, but that's it.
I can tell you what I would like to see my company doing is at this moment that you're under stress, let's say, because your business doesn't go well. I would like them to act in the good faith, not of the shareholder necessarily, but of the future of the company. So not live up to the quarterly expectations like Intel does now. Kind of, they're in the squeeze there. I would just stop giving expectations. Yes, I will get a hit on the share price. Yes, it might cost my job if I'm not in a family business. However, I would like to watch myself in the mirror, so I would really start innovating in the portfolio better late than never. I've got it easy saying because I'm not a CEO. I don't have any incentives that I need to fulfill or KPIs. But I would probably even want to negotiate if I would be the CEO that I have long-term incentives and not quarterly incentives. So, and then what the margins should be, I don't care then really about. It's more like innovate for the future of the portfolio.
In an ideal world, that sounds good, but I'd imagine as a
exactly.
CEO of a company, that's probably a lot
really
harder.
hard.
And even as if you're of your own family-run business, that's still a pretty hard stance to take because if you need cash now or your business is struggling, it's hard to justify. Oh, I'm going to take X amount and put this for the future when you're struggling now. So
you become a prey. Yeah.
Yeah.
What if the shareholders say, okay, Mr. eDGI, let's drop your share price by 50%. Yeah, and then there will be other companies that think like, wow, that's a value play. Let's get the CEO removed, buy the company, and increase the share price really quickly. Simple like that. So you have all the time this threat at you. So yeah, it's really difficult, I think.
A really good question, though. Really good question, and one that will be playing on my mind probably for the next few days as well. So the next one then is from Russ over in Dapper Dividends, and he said, "Do you think we will see a shift from growth to value, and do you think it has already begun?" And I'm happy this time Russ hasn't actually answered his own question yet. He's actually given us a chance to answer it for him.
I've been always looking at value and not at growth because it's not in my circle of competence. So I didn't even, I mean, I know, of course, that there is now a market for growth stocks, right?
Mm.
I hope. But what does it mean, right? If that means that there is value now, yeah. I find even the stocks that are typically considered value, I find them highly valued. I mean, look at the Procter and Gambles and the Walmarts of this world. I find them not attractive from a share price point of view. So for me, the market should still go down 20-30% before I really see value plays a lot. But I don't think that's maybe necessarily what he meant here with the question.
Yeah, like I believe we will see a shift from growth to value at some point. I don't think it has already begun. I still think there's growth there. As you said, prices are overvalued. I'm struggling to find companies that are value play, so to speak. So I don't think that shift has happened yet. I seen an article, I don't know if it's on Seeking Alpha, that compared actually growth to value stocks over the last 10 years, and growth stocks has way outperformed. But I do think we will, like, they won't go up forever and ever, and we will see some sort of maybe 10-20% drop, and then we might see the value play, like people are buying the Teslas or the high growth stocks might want to panic a little bit and may then go into more value play. So as I said, I don't think it has begun, but I mean, look, everybody wants value, and that's what they're looking for, isn't it?
Yeah, but if they all go in value, then it will be even more overvalued.
Yeah.
There's this kind of continuum. Yeah. Okay. Thank you, Russ. It's a very interesting question, but I guess hard to be happy with if that would happen from my point of view.
Okay. And then we have one from Rep Stones, and he said, "Do you incorporate spread bets into your portfolio?"
Honestly, I don't know what spread bets are.
Okay. So the answer for me is no. I have looked at it before because spread betting is tax free, and you can bet against the direction of a price, and then depending on how far it goes above or below your price depends on the amount of profit and loss. It looks attractive. I've mentioned before that I've looked at match betting and that kind of area, and spread betting was one area within that could be manipulated, but it is very high risk. And I mean, I've learned over time that my risk tolerance is not as high as I thought it was, and that's just something that's a little bit too risky for me. I'm sure there's management and that, but I find the psychology of these kind of trades and these kind of methods doesn't really suit me, so I tend to stay away from it.
Okay, then a question from Danny. How have our portfolios performed so far, and which one of you have done better? So when it comes to portfolio performance, I think we did a show like 2-3 episodes ago about that at the start of October. But I can tell you, I mean, my portfolio, I think, is in the minus for this year because Shell is 50% down, ExxonMobil 50% down, Bayer 45% down, Microsoft up, Apple threefold up. I don't know actually because I don't track my portfolio as a whole as such when it comes to price appreciation, but I would assume it's somewhere probably between 0 and -5% over the year. So yeah, depending on your answer, we will know who has done better.
I have. No, I'm joking. So no, I'm the same. I don't really track. I don't really keep a track of the stock price if it's a green day or a red day, or once a quarter I do look at portfolio attribution and I do compare it against a set of indexes. And look, I've underperformed them this year, as we know, and we've discussed in the previous episodes. But I suppose if you're asking which one has done better, we're both investing for income, right? And that's our goal.
Yeah.
It's not price appreciation. It's not anything like that. So purely on income, you win hands down. You're in the game a little bit longer, and you're seeing perpetual growth, and you're seeing a lot more bang for your buck due to the amount of dividends. So you're ahead on that front. But I mean, look, it's not a competition. Each investor has their own goals and targets, and I'm quite content and happy with how I'm progressing at the moment.
I would start tracking price performance if I would intend to sell, and I don't buy to sell, hence why it's actually not really an issue for me. And actually, the more I look sometimes when I look at my portfolio and I see the total value, it distracts me from what I'm actually doing, because then I see like, oh, my portfolio went few thousand lower or higher compared to the last time when I looked at it. And then I start thinking, and then I think after a few minutes, like, why am I thinking about this? It doesn't make, I'm getting this psychology that I don't want to have this unwanted roommate in my head starts waking up then. So it's even better for me to not even look at it. And I have just one figure, which is my dividend income, projected annual dividend income. And that's what I just want to see up. And every time when I put some money in the market again, it ticks up a little bit. And that's most important for me.
Very good. Okay, and we'll move on to Wolf of Harcourt. And he asked, and he can probably guess from earlier in the show, but which earnings report surprised you the most this week and why?
Yeah, Intel, because look, credits to you. You wrote for me an excellent blog post about Intel. Yeah, exactly on the right level. How I love to read the information. I also really appreciated that you kept a section open for what the quarterly 3 earnings would be, to give yourself a little bit of an openness to that. And actually, you made me, after reading that post, you made me rethink some of my preconceptions about the company, specifically when it came to the data center space. And then this is where Intel surprised me by underperforming. And I think that's what many investors saw. So kudos to you for writing an excellent piece on this. But this was also one of the reasons why it surprised me.
Yeah, and I wonder to myself, if I was to write that post this week, would it have the same outcome, or would I have the same results? But I mean, I was surprised. I mean, 47% drop was incredible. I don't think anybody expected that. I still, to your point earlier, do I think this company will be here in 20 years' time? I do. They are a cash cow, and look, their market share is huge. I know they're losing some to AMD and they're losing some to TCM or TSM, but they still have a considerable market share at the moment, and they still generate huge amounts of cash flow. And purely from a dividend growth and dividend point of view, I'm happy. I did buy some when they dropped down. Bought them at 48. I said I was going to buy some, and my thesis doesn't change on one earnings report. And I think I've learned that you can't just change because of one. It is a long term game, and for me, there is more upside than downside at the moment. I mean, the price can still go down, but I don't see them going down another 30-40%. So I'm quite happy with the dividend and to invest. I think I got them close to 3% dividend yield, which is pretty good.
Yeah.
So yeah, no, I was surprised with how they perform, but look, it gave me a better buying opportunity, so I'm kind of happy.
Next one is from Dividend Wave, who we got to meet yesterday for the first time. Great guy, I must say. Really knowledgeable. Watches one pages all the time there. Now that I've seen him in real and also saw him speaking, I'm even more intrigued by his one pages. And he asks us, AMD revenue up or down, and by how much? What do you think?
I am going to guess it's going to be up by 14%.
Okay. I don't think it will be down, but I think it will be not as per expectations, and tell you why. I think a lot of, just think about it. In Q2, at least in Europe, all companies suddenly had to shift really quickly to digital. That meant lots of cloud solutions, lots of processing power required. Also, people started buying laptops a lot. So I think a lot of those sales have been brought forward. And I think a lot of those were initial one-offs. So I think, therefore, that if the expectations are that people are extrapolating Q2 earnings, I think it will disappoint in Q3. So will it be up or down? It's probably not the right question for me. I think it will be disappointing compared to if people take Q2 as a reference. That's my kind of hypothesis here.
Okay, but it's still going to be an interesting watch to see how they actually perform compared to Intel. It's going to tell if it's disappointing like Intel, there might be a bit of rebound and it might level out the playing field. But it's certainly going to make next Tuesday, I think, interesting.
Yeah, definitely. Really nice. I said industry to observe at the moment. This is literally like really really intense competition, and it's really like they're in the boxing ring almost. It's really nice to see.
Cool. And then the last question came from Richard. He asked who would win in an arm wrestle.
I think you're a bit younger than me, so you should still have a better muscles than I have, and you're Irish.
It depends how much tequila we drink.
I would count on you. But Richard, hey, join one time Dividend Day evening calls or maybe a next dividend quiz or something like that. You'll be able to judge yourself. We can do a virtual arm wrestling.
So again, thanks guys for all the questions. We love them. There's some tricky ones there today and really get the brain ticking over. So thanks a million. Really enjoyed them.
So let's go to our one of our favorite sections then again, stock picks. And these are harder week by week, right, to come with a stock pick. But hey, challenge accepted. What's your stock pick for the week, EMF?
Yeah, I mean, I'm struggling to find, as I mentioned earlier, struggling to find something of value. So I cheated a little bit this week. I went on to Finviz, which is a stock screener and has loads of different metrics that you can choose. So the ones that came up for me were ADP, British Tobacco, Cisco, and Unilever. And I suppose we've picked most of them over the last few weeks. So I decided to pick one that I haven't picked in a while, which was ADP. And I mean, I did a quick valuation on him, and I had him as slightly undervalued, but I'm not quite sure that that's true. So I did a dividend discount model on him. I didn't do a cash flow analysis or anything like that. So I would certainly research them a little bit and see where they're at. But they have a decent dividend yield. They're okay with the free cash flow payout ratio. I think it's around 60%, and look, they have a super dividend growth history. So definitely one I would consider. Who are you going to pick?
Yeah, for me, it's just Danone. Again, it's not a buy recommendation or something like that, but I just bought some this week. Again, I'm now at what is it? I think 42% position size for what I want to have for the company, and it was close to 50. I have a buy order outstanding at 50 as well. I actually want to wait until November, because then I have my new salary, so new cash contribution. And if I would buy now, I would take it from my kind of reserves, which are there for interesting opportunities, but probably there. In general, I can tell you, I stopped all my options at the moment that I have. I have still one or two really long-term running because I'm waiting for the presidential election, which is in 2 weeks from now. And I don't know what will happen. I can imagine that there will be like the day after maybe a really strong market reaction. If that's the case, then I'm rather not in options. But I also don't need to be a stock market hero. So I will probably pause my investments a little bit until I've seen what happens with the election. And maybe it creates more buying opportunities than we have today. And otherwise, well, there will be other again later. But if there comes a significant stock market drop, then I will be really hunting for the companies like Johnson & Johnson and such.
Hey, I noticed you changed your pronunciation of Danone.
Yes, because I got some feedback of Danone. So I'm, feedback taken. We need to continuously learn and adjust to the new facts. So I'm now trying to pronounce it Danone. And I also heard someone saying yesterday, I think it was Dividend Wave, or it was Phil. No, Phil it was. He said like, and in French it's Danone or something like that. I love this. This is what I love about this podcast as well, and interacting with the European community is so diverse. Yeah, the cultures are so diverse, and we have people from Romania, from the eastern part of Europe, often reaching out, the western part, south, north. I mean, it's all over the place in the community, and I just love this. I really love this about this, and this podcast even brings it more together, and that's for me just really nice about this.
Yeah. Look, I think that's a great way to end the show. Thanks a million to everyone for listening, and I agree with your sentiments there. It's a great little community, and look, we hope to get involved a lot more. We do have a Twitter group, and we do have all sorts, and you can reach out to us on email or Twitter. So we look forward to hearing from you, and see you next week.